Welcome to Convince Me in 15 Minutes, where we give our guests 15 minutes to convince us about timely topics in the financial services industry. Before we begin, please subscribe below. The Convince Me in 15 Minutes podcast will introduce you to new concepts, theories, philosophies, and practices in the financial services industry. Your guides are Luke Tawas and Keith Thompson. We'll follow up the initial presentation with questions. So again, subscribe below and we'll introduce our guest speaker.
Hi, my name is Loutsenko. I'm founder and CEO of OVOM Research, and I'm here to convince you why I believe the U.S. labor market's on the verge of breaking down, and that'll ultimately lead to another U.S. recession. So the first slide that I wanted to start with is just two of the key metrics that most people, whether looking at the market from a macro perspective or just an economic perspective in general, two labor market indicators that market participants frequently look at. So initial jobless claims, which is in orange there, and then the U.S. unemployment rate, which is in red. And initial jobless claims are kind of known as a leading indicator in the labor market. So before a lot of these recessions, you'll see initial claims start to move upward, and then the U.S. unemployment rate, which is pretty popularized, in financial markets, but it's a lagging indicator, so it tends to follow initial claims moving upwards into recession. So just to kind of go back to that point, you'll see in the actual recession bands, the unemployment rate almost never really starts to move up until we get into that recession. But for initial claims in pretty much every cycle, you'll see them start to move up and then really spike up into recession. This is an interesting slide that I want to explain a little bit. So the green is initial claims year over year. And then the red is the federal funds rate calculated using a 12-month BPS rate of change and advanced 18 months. Monetary policy lag just refers to the concept that when the Fed starts to hike interest rates, they typically impact the broader economy after a period of lag. So here we see starting in the mid 1980s, after about 18 months is when we see initial claims start to kind of move upward into recession. Okay, so this slide I want to go into a little bit more detail, just because small businesses are such an important part of the labor market. A lot of the times in financial media and stuff like that, we'll hear about layoffs at large corporations or things like that. But small businesses are important because they actually have 71% of the full-time labor force in the U.S. And also turnover from small business employees getting laid off. It's a lot tougher for them typically to find jobs than those who get laid off from large corporations. So the calculation I used, the green is just the U.S. unemployment rate. The red line is the National Federation of Independent Businesses. It's a small business kind of survey. They've indexed. We do believe that, not necessarily just because of the chart, but because of the way contractionary monetary policy lag works, that we should expect, and also the data we're seeing, that we should expect some loosening in the labor market and small businesses in particular, which I would argue have been responsible kind of for the broader resilience we've seen in the labor market and, by extension, the U.S. economy. But we don't expect that to hold up. And, as the chart indicates, I think actually 6 months from now is probably a reasonable time frame that we can expect to see the unemployment materially kind of move up. This just kind of taking a step back to U.S. Fed hiking cycles. So there's going to be a slide about the yields curve. But my view, as it relates to also risk assets in the equity market, which I'll get to at the end, um, my thesis on that was built on two factors. So the Fed, starting their hiking cycle after they, eventually got around to figuring out that inflation wasn't, transitory. As this chart indicates, since the early 1970s, there's been really one Fed hiking cycle in the mid 1990s that didn't result in a recession. Some people, argue that the mid 1980s was also kind of a hiking cycle that didn't end in recession, which you'll kind of see there between 83 and 84. The Fed did hike again, but they were coming down from a 20% federal funds rate. It was a much different kind of dynamic with the Feds. So this is an interesting side I wanted to briefly touch on because not only people that you guys have had on, but people I've heard speak throughout financial media about the inflation that we're seeing and how it relates to unemployment. The feeling that I'm getting is that a lot of people think that we could have like a reemergence of inflation and a rising unemployment rate at the same time. And not only is that not really supported historically by the periods of time where we've seen surge inflation, which was the mid and early 1940s, 1950s, and then the 1970s, but it's not all that intuitive because I don't know if I don't know how many people have talked about this, but it's the inflation that we're predominantly seeing is services inflation. So a lot of the sticky inflation is in the labor market. So if you're betting on inflation reaccelerating, you're essentially betting on the immaculate disinflation narrative that Chairman Powell had initially hoped for. As the next couple of slides will show, I think it's going to be certainly a deflationary recession first, and then perhaps because of some fiscal things going on, with the U.S. government and other advanced economies, we could have a reemergence then. But I firmly believe it's going to start with a pretty severe disinflationary recession. So it doesn't get more deflationary than this. The change in the U.S. M2 money supply on a year-over-year basis, it hasn't been negative since the Great Depression era. The chart, excuse me, unfortunately doesn't go back that far, but the money supply has never contracted at this rate except, excuse me, it was either during the actual Great Depression, where we saw extreme deflation, I still think there's too much money, quite frankly, in the economy, but we're gonna feel this with a lag, and this is gonna be majorly deflationary. And honestly, I don't know why more people aren't talking about this, but yeah, that's definitely a big deflationary recession indicator on my radar. Like I said, besides the Fed hiking, the second thing that really made me question the bullish thesis on the equity market is the inverted 10-2 yield curve spread. So the U.S. Treasury market is the most liquid funding market in the world. I know there's misconception among some people that like when institutions or any investors really, when they when they buy like a 30-year, treasury bill, that they intend to keep it to maturity, and that's just simply not the case. And what such a deeply inverted yields curve is telling us is, that there's a substantially much higher demand for shorter term maturities, and that typically happens when investors get pessimistic about the long-term economic prospects, and they want to own the shorter end of the curve. The problem with that is that in private credit markets, by definition, they're private, and we don't have much insight into them. But they're all like highly leveraged markets that kind of operate on an understanding of what's going to happen the next day. And this is just showing how the 10-year, 2-year yields curve spread. It steepens into recession, and actually, if you look at where we are in this cycle, you could make an interesting case that we're kind of maybe sharply steepening into one, but I'll leave the speculation for later. But basically, the point here is that the yields curve steepens into recession, and the U.S. unemployment rate is right behind it, rising into recession. So they kind of have like a structural relationship, and again, the yields curve appears to be steepening. So we'll have to see with the unemployment rate, but the historical relationship is pretty undeniable. So this is another probably phenomenon that most people are familiar with in respect to 2023 with the U.S. equity market. But the gains in last year, they were I should probably the green area represents the top 10 stocks by market cap in the S&P 500, and the blue is the bottom 490 by market cap. So what we see here is, even at the start of December, it looked like the market, literally all the gains were concentrated into the top 10 stocks by market capitalization, which it's extremely unusual if we were in the early stages of a growing business cycle. That's not when we see mega caps drastically outperforming. That's when we should see small caps and the Russell 2000 kind of leading the charge. So last year was very curious that we turned around the bear market with the most expensive, highest capitalized stocks that quite frankly, investors who went long on them, they already made their money. It doesn't, Apple at a $3 trillion enterprise value. From our perspective, there's not much more room for upward potential, and you're getting all of the market risk with very little upside. So entering 2024, yes, 2023 was ultimately a good year for the S&P 500. But I think it's also important to keep in mind that it was a good year for the S&P 500 market cap weighted index, and really what we saw is maybe a dozen companies did great, and a lot of household names in the S&P 500 suffered pretty greatly. So heading into 2024, I think that's an important theme, because a lot of people are still very bullish on mega cap tech. This I think from an equity market perspective, this is probably the most important chart in the presentation. So I didn't, obviously I didn't include a reference for every bear market, but if you look at I prefer to use the CAPE ratio to price to earnings, because it's cyclically adjusted earnings. Just makes more sense. It kind of takes out like the seasonality of earnings in some sectors. But anyway, so the CAPE ratio today is actually, it's right near the peak preceding the Great Depression, and you could see how far down valuations came. I'm not saying that that's what we're going to see by any means, but the I think the probably the most curious part about this is the last bear market, which is where the last bear market ended, which is a little bit below where we are now. That's still extremely high relative to history. Um, I It's not in the chart, but I looked at other bear markets. Um, I think this was the highest cape to end a bear market by something like 5. Um, but you could see dating back to 1880. I mean, it's the market's definitely expensive. For me, there's no way of kind of like tiptoeing around that.
One of the things that you talked about, especially with small businesses, is that they make up what I think was north of 70% of the employment. Is that correct?
The full-time labor force in the U.S., right?
And the other thing you talked about, though, in terms of inflation and the stickiness of inflation, it has to do with wages mostly. Is that correct? Not other factors.
That's my current understanding. Yeah.
Okay. So when you look at the fact that most of the employment is coming from private employment, not large employers, and that inflation is sticky mostly because of wages, I look at some of these states here recently that have just increased minimum wages to $15 an hour. Even if you have higher unemployment, when they do start coming back to the workforce, they're still coming back at those high wages, correct?
For now they are. So we still have a tight labor market. I think we're starting the reason I think it's kind of it's similar to like in preceding 2008. Like we just had the JOLTS quits rate released, and it went down to 2.1%. So, and that's really a historic low. So people for the most part, wanna retain their jobs, and also what we're seeing in the ISM's employment index, there's an hours worked component. Workers' hours are going down. So my sense is that a lot of people are just kind of struggling or kind of just clinging on to their jobs. And I think businesses are just kind of hanging on and hoping for rate cuts. A lot of small businesses.
Yeah.
Mhm.
I was going to say, how much did demographics play into this, where you have this kind of aging workforce, many of whom have just dropped out of the workforce and called it a day? And will that tighter labor market have an impact on kind of how long things last? I'm just trying to wrap my head around it.
Yeah, absolutely. That's a great question, actually. So that's the reason we have the historic labor shortage in this cycle that we do. And I definitely think that that's contributing to the resilience that we've seen thus far. So just for comparison's sake, entering the great financial crisis in 2005, initial jobless claims were steady at 330,000 or so, and then they went up to 500, 600, and a million pretty quickly. But in this cycle, we were even below 200,000 initial claims some weeks. We're averaging, roughly 220. I think, the fact that there are less people, probably less qualified people who kind of, called it quits, like you said, I think that's definitely playing into, more jobs being available than perhaps otherwise. And yeah, it's definitely extending and could possibly extend further the resilience of the labor market. But the thing is, we've never seen an indefinitely resilient labor market, and it doesn't have to necessarily be some deflationary event that causes small businesses to have to start laying off people. It could be a credit event, like we saw in 2008 or 2001, where people just inevitably start getting laid off. But yeah, I definitely think your point's certainly valid.
Invariably, our listening audience, they're capital allocators in terms of building portfolios for their clients. And you talked about a big chunk of the S&P being cap weighted, and that's been driving performance. If you were allocating right now, then I would imagine you'd be looking at something like an equal weighted S&P rather than a cap weighted S&P. And I'm going to ask a secondary question here. The investing populace is much different now than it has been, say, 20, 25 years ago, in terms of lay people having a lot of money allocated to these things. Is this going to be self-fulfilling prophecy on the way down? Because if those 5 or 7 names roll over, then there might be a selling process, and you get this kind of cascading effect.
I mean, that's certainly a scenario that we think is pretty likely. I mean, right now we have an environment in the U.S. equity market where there's like a notion that valuations aren't really all that relevant when the market's traded on earnings since the S&P 500 index that we know today was introduced in 1957. So especially when we see some kind of economic disappointment, doesn't necessarily have to be recession. Market participants will start looking very attentively to earnings. And for example, Apple. Apple's the most owned company in the world, public company in the world by volume. And when you think of a lot of the ways that Apple makes their money in a recession, you got to figure that the number of people who are gonna be super gung ho about like the iPhone 26 or the AirBuds 5 or things like that aren't gonna be anywhere near they are today, or anywhere near what analysts are estimating them to be, because no one's pricing in a recession. So definitely, I think that if the thing is, the 2022 bear market occurred because market participants realized with surge inflation these valuations are ridiculous, but they're still not priced for recession. So I think they have a much further way down to go. And again, in recession, even like not retail investors, maybe not necessarily institutional investors, but like pretty high net worth investors, they'll be thinking of their pensions and putting their kids through college, and their real estate property values, and how their returns on other assets certainly are doing compared to the equity market. So right now, the S&P 500 earnings yields was 3.85% on yesterday, on January 4th. And right now, this is what I really don't understand. Like, I don't understand why a lot of people are taking so much market risk in mega caps when money market funds are offering 5.25%, and that's like free money. Versus taking a lot of market risk on Apple, who's lost revenue year over year 4 straight quarters for the first time in their history, and this is again pre economic slowdown.
So Oliver, I actually went back and opened up my textbook from economics from years ago about the concept of soft landing, and this is what it read. It refers to the successful slowing of an overheated economy through monetary policy, tightening, in this case, hiking interest rates without causing a recession. But what's interesting about the textbook, it goes on to talk about external factors which are out of the control of the Federal Reserve. And so in this case, for example, global economic conditions, geopolitical events, technological changes. I mean, AI for technological changes, geopolitical events. We have 2 wars in the world, global economics, conditions. I mean, the reality here is there's a lot of other things going on. What does that say about this chart and all the other charts that you've gone through today? Isn't it much more difficult for the Fed today to navigate these markets?
I mean, if like you said, the Fed has to deal with those issues on top of the most aggressive hiking cycle in their history, then we're in a lot of trouble. But I think certainly those like especially the what we're seeing in the U.S. Treasury market, we're not seeing the same kind of like robust buyers and sellers that we've seen. We've seen China selling off massive amounts. It's questionable how much more Japan's going to buy, but so I think the Fed has plenty to do kind of internally. But looking at this chart, so let's discount the mid 1990s. What we could see from pretty much every other cycle is when the Fed, there's a misconception like about monetary policy lag also. Rate cuts work with a lag. So if you look at the early 1990s, the tech bust, the GFC, I mean COVID, it actually fits the criteria, but that's the exogenous event that I would argue. What we see in all those cycles is the Fed starts cutting too late. So, you could see the Fed starts cutting very soon after recession. And, I just remember the GFC personally well. The Fed started cutting in early 2007. And the recession itself, the NBER recession itself started in December of 2007, but the equity market didn't realize anything was wrong until Lehman went bankrupt or insolvent in 2008. I think it's also to keep it's important to keep that in mind, that recessions are determined in hindsight. So a lot of not a lot of the times, pretty much every case, we don't know we're in a recession until we really know we're in a recession. If there's one final point I could make, it's that interest rates, they inherently lead the business cycle. And, in terms of their relationship to the equity market, I know this is like a macro specific chart, but, I included that higher interest rates, lower prices paid as showed in this chart, and then lower prices paid transition to a weakening economy. And what that means for the equity market is lower than anticipated EPS growth. So right now, the market is pricing in 10% EPS growth in 2024 and 12% in 2025. And those are, even for secular bull markets, those are on the high end. Really this chart, I don't even think does, like enough service to, how far off, I think EPS estimates are in the S&P 500. I don't think there's been there's been virtually no consideration for the lag at which monetary policy operates. Like people talk about, maybe there'll be a recession this year, but it's not priced into the market.
Thank you so very much for joining us today. This has been incredibly fascinating. I think we could have talked with you for another couple of hours with all the data that you gave us here. We certainly look forward to having you on again. Luke, do you have any final parting thoughts?
No, thank you so much for your time, Oliver. We really appreciate it. And thank you so much for taking the time to put together all these wonderful charts. I know you're a top voice on LinkedIn. I'm not sure how you earned that, but after seeing all these charts, I know you deserve it. So congratulations.
I appreciate it. Thanks a lot, guys. It was a lot of fun. Thanks for having me on, and definitely more than happy to come back again. Thanks again.
Thanks for joining Convince Me in 15 Minutes. If you enjoyed the show, please like and subscribe below. If you'd like to be our guest, please reach out to us on LinkedIn.